Morning, everyone, and thank you for joining our webinar this morning. My name is Kim Kellaway, and I'm Head of Clients and Markets at HLB Mann Judd, and I will be your moderator and facilitator this morning. Today, we are presenting all your finance needs in one place, presented by our panel of experts. And I'd like to introduce our experts to you. Jonathan Philpott, Partner, Personal Wealth Management; Betty Preshaw, Director, Debt Advisory; Andrew Kennedy, Risk Advisor, Insurance Services; and Robert Monaghan, Director and Lawyer of our Estate Services. So before we start, I encourage you to use the control panel for Q&A, and then what we will do is we will answer questions at the end of our webinar this morning. So let's start. So the personal wealth advisory space has had some interesting few years, with the Royal Commission pointing out that the failings of the industry over a number of years: fees for no service, poor advice, selling own products, overall just too many conflicts that does not result in the clients receiving professional advice. So how does HLB Mann Judd differentiate themselves? Jono, over to you.
Okay, thanks, Kim. It's a fairly hard-hitting question to start off with. But look, the Royal Commission has certainly significantly changed the wealth management industry, and it is for the better. We've got the big four banks that have all now exited or are in the process of exiting the industry. That obviously leaves a very big hole in the wealth management space there. It's probably only about 5 years ago that about 75% of advisors were all licensed through the banks or AMP. And that's now very quickly changing into small businesses and often single advisors now setting up on their own little practice in this space here. And the other significant change was the educational and the regulatory changes that's going on. And so all advisors, they need to pass a national exam, and that's this year. And they also need to have an approved university degree by 2026. So that's a big change in regards to how many advisors there will be going forward. I think at the moment there's roughly about 25,000 advisors in the industry, and it's expected by 2026 that's going to drop down to about 15,000 advisors. So a fairly big change. But things and the regulatory change is kind of stuff that you'd think is just part of being a profession and part of doing the right thing, such as stopping conflicts of interest, making sure that advisors properly service clients, things that really we'd take for granted there. So look, I think our approach to wealth management is obviously very different to the way that big institutions provide it. And one of the key differences is that we've simply never had any of our own products to sell. There is no HLB investments that we're pushing clients into. We've always felt that clients should be going to the investments that best suit them. And really, whatever was available in the market, that's what we chose. We never had anyone over our shoulder telling us, what it was that we should be investing into. We commenced our wealth management division in the firm back in '99. And really back then it was focused in on providing investment advice to our self-managed superannuation fund clients. It has now obviously expanded over the years, and we have a much broader range of clients that we're looking after. But we only have 200 clients today that Michael Hutton and myself both look after. I am pleased to say that we will have 2 female advisors taking on the advisor client responsibility next year. They've both been with our firm now for over 10 years each, so well and truly served their apprenticeships. I think over the years what we realised was that this is it's quite a broad area, wealth management advice, and you really do need to have specialists in the areas to be providing certain advice. And for many years, Michael and myself used to attend estate planning updates and even courses, and they're always run by Robert Monaghan. In fact, Robert has written a book on estate planning up to its 4th edition now. 5th is is in the process of being printed. And we were lucky enough a number of years ago to ask Robert to really establish HLB Estate Services with us, and Robert's now been with us for a number of years there, and Betty and James McFarlane in the debt advisory space, again now for a number of years we've been able to provide that service there. And Andrew Kennedy's been with the firm for well over 10 years, but he's been specialising in this risk space now for about the last 3 years there. So, where it's needed, we've brought in the specialists into the firm to really round out our wealth management services. And the other important thing is that we're a division of a mid-tier accounting firm, and we sit in this firm, particularly on the level that we're at with all our accounting and tax guys, and we obviously have some of the best in Sydney in that area as well. So, able to talk jointly to our clients on structuring advice and exiting businesses and all that sort of thing, and wrapping the wealth solutions in with that, to me is a really great differentiator that we have from the rest of the industry there. And probably I guess our competition sort of in this space is the private banking, investment banking advisors, and where they differ from our approach is that they just simply stay focused in on the investments only. When it comes to any tax or legal matters or whatever sort of thing with it all, it's just simply, no, you speak to your accountant about that, or speak to the lawyer or whatever. So they're really just focused in on an investment solution. Whereas, as I said, we've got that more well-rounded, I think, solution for clients going forward. They don't need to tell their story to 4 or 5 different people. It's all in the one place.
Thank you, Jono. So I'm now going to ask you, could you take us through the different steps of wealth advice and how we approach each stage regarding providing advice?
Yes, so well, first of all, we all have our own financial journey, and that's actually one of the great things with working in wealth, that you do get to hear so many different stories. But there is certainly what we call different financial stages that we will move throughout our life, and that's obviously governed by the regulations, the tax rules, the super rules, etc., that we all need to follow. And then also there's certain traits that we all like to have. We all like to have a roof over our heads. We tend to want to protect our family. Many of us have goals of leaving some sort of legacy to our children. So look, we look at the whole wealth management journey in these 5 different stages: early career, homeowner, wealth builder, pre-retirees, and the retiree stage there. And very quickly, the early career, this is when you're obviously getting that your first job. You're starting to become a little bit more financially independent. It's about setting goals. Might be purchasing that first car, even perhaps saving up for the home deposit. So it's cash flow planning, budgeting, getting those basics all down pat. What I also encourage with younger people is actually to start some sort of investment plan going, and whether just whether it's a monthly saving into a managed fund or a share type of investment. I think the experience of seeing the markets, the ups and downs of the markets, the longer that you've built up that experience for, obviously the better prepared you are for later on in life, where you're dealing with larger sums of money, and we go through the GFCs and the 40% pullbacks that happened this year with COVID and so forth. The homeowner stage is really where there's a lot going on in life, and this is where you're doing that first home purchase. You up until this date, there's certainly the biggest financial decision that you've ever made. How much can you afford? And in life, there's a lot going on. You may have a new partner in your life now. There might be children there, and you're looking to upgrade from an apartment now into a home. So debt is obviously a huge part, and managing the debt, and not just just life goes on sort of thing, and you find yourself all of a sudden you've worked nearly your whole entire life, and all you've really done is just repay the mortgage on your home. You need to take better control of the finances there. But this is also the stage at home ownership where you really need to be getting your personal insurances in order as well. And again, a lot is changing here. First of all, you're starting with making sure you're properly insured yourself. And then if family comes along, making sure there's adequate cover all in place if something was to happen to you. And also estate planning should be sorted out at this home ownership stage here, but most people do not. So look, the wealth builder and the pre-retiree stage, I will come back to and have a little bit of a chat about after Betty, Andrew, and Robert. I will just quickly speak about the retiree stage, and to us, this is actually more about being financially independent. And well, what does that mean? And really, this is a stage of your life where you're looking to have built up sufficient wealth in that. Yeah, it's sufficient investment wealth in that work is now just a choice that you have rather than a financial necessity that you need to continue working with. So you've obviously put enough wealth aside within your superannuation funds, perhaps outside of superannuation, but you're certainly the work side of things is there more for enjoyment. And in fact, we're seeing it more and more. People are saying, look, I love work. I don't wish to finish up work. I know I've got enough money to retire, but I want to continue working. And it was only, I think, yesterday, Jerry Harvey said at the Harvey Norman AGM, I plan to stay on until I'm 100 years old in the place. So he's obviously feeling really good about himself. And then you've got the whole, the $64 question is, how much do I need to retire on? That obviously depends on how much you're going to spend. But I think a really good rule of thumb that we often work by is what we call a 5% drawdown rate. And that's simply saying that if you were to basically draw down about 5% of your capital throughout your retirement years, you're unlikely to run out of money. In fact, you're very unlikely to ever run out of money. So keeping it at that 5% drawdown. So that would mean if you wanted $100,000 per annum to live on, that would mean you'd need $2 million in investment capital there to live on. If it was $200,000 a year you wanted to live on, that's a $4 million capital sum that you would need. So, and then just finally, the legacy issue. Some people they've worked their whole life and they wish to now largely preserve their capital that they've built up. Others are more happy to perhaps say, look, we'll spend our superannuation over the rest of our lives. We'll enjoy that, and the kids will get the Sydney home or something like that. We're all very different with our needs, but it's often, it's certainly an important point for many people there. So Kim, I'll finish up there.
Thank you. Thank you so much, Jono. So we're now going to ask some questions of Betty. Interest rates are so low and debt is just so cheap. Betty, what's happening with the interest rates at the moment, and how loyal do you need to be to your current bank?
Thanks, Kim. Look, if you've been with your bank for more than 2 or 3 years, then it is highly likely you are paying too much when it comes to your home loan or your debt. The cash rate's never been as low as it is at the moment at 10 basis points. There's not much room to move for the RBA unless we enter into a negative interest rate environment, which is highly unlikely. So the lenders have passed on this rate cut to the majority of their fixed rate products. The variable rate hasn't necessarily seen the rate cut. So the best fixed rate on the market today is around 1.89% fixed for 2 years. So the lenders have all got this retention strategy of locking in customers to get them through these difficult times. It's also easier to get money today as well. The Living Expense Spotlight is a bit more flexible than when the Royal Commission announced their findings early last year, and discretionary expenses are a bit more flexible as to the way the lenders look at them. And also the assessment rates have dropped, so it actually is easier to borrow money. The banks are certainly open for business, and the government's encouraging us to spend that money and assist with the growth of the economy.
Thank you. So what are the advantages and disadvantages to fixed rate loans and variable rate loans?
So yeah, so the fixed rate loan's never been as low as it has been. So you're looking at a rate of around 1.89%. The best variable rate at the moment's about 2.5%, and that's a variable rate with an offset account. So the difference between the two is quite large. It's actually never been as large as it has been until now. But you need to be careful, because with the fixed rate loans, if you do want to take advantage of the fact that the rates are so good, you are entering into a contract with the bank. So you need to ensure that your circumstances won't be changing for that fixed rate period. You know, for example, selling your house. You don't want to be selling your house and having to pay down your loan and having to break that fixed rate loan, because fixed rate loan, breaking a fixed rate loan is, the break fees are quite large, usually in the thousands. As you are paying the economic costs to the bank, it's usually the loss margin for the bank. So if you fix your loan, you need to make sure that that period, it's not going to change over that period. Extra repayments are also not allowed for a fixed rate loan. So you're limited to the amount of extra repayments you make. Variable rate loans, on the other hand, are a way more flexible product. You can make as many extra repayments as you like. You can redraw funds as well. A lot of variable rate loans have benefits of an offset account, and an offset account is a transaction account or a savings account that's linked to your home loan. And every extra dollar that goes into that offset account is though it's working, it's sitting in your home loan, so it's actually working for you. So what a lot of people are doing in today's market is to take advantage of the fact that fixed rates are so good, are locking in a portion of their loan with a fixed rate loan, and then also having a portion of the loan at a variable rate. So, you know, still having that flexibility. So I've got clients, for example, professional clients that earn large bonuses as the way they are paid. And so therefore they've done that. They've got a variable rate loan that allows them, when these bonus payments come through, they can put that money into their loan directly, or they can put it into their offset account and redraw that funds whenever they need to. But at the same time, that money is working for them and they aren't paying interest on their loan for that portion of funds that's sitting in that offset account.
Okay, thank you. Is refinancing the only way to get the best rate at the moment?
In most cases, I would say yes. In today's environment, however, most banks are offering really sharp fixed rates. So you could potentially fix your home loan with your existing bank. A lot of banks, again, are offering super sharp fixed rates, but only for new customers. So if you're an existing customer, you pay a premium on that fixed rate loan. And also by locking in with your existing bank at a sharp rate, you're not necessarily getting the sharpest rate on the market, right? So, but yeah, so I guess shopping it around and making sure that you are getting, you know, a very attractive rate would be absolutely my recommendation.
Okay, wonderful. So getting a cheap rate, you've then got the expenses of refinancing. How expensive is it to refinance?
This question I get a lot. So people think that it's expensive to refinance, and it's actually not. Usually the costs are the discharge of mortgage from the outgoing bank and then the registration of mortgage from the incoming bank, and they're the government fees. And they're usually around $700 to $1,000, and this is on a variable rate loan. So assuming you're not in a fixed rate product, because again, if you're in a fixed rate product, you're breaking that contract and therefore you are liable for the economic costs to the bank, and that's usually the loss margin, which is, you know, in the thousands of dollars. So it's actually not expensive when you look at the benefit of potentially taking advantage of the sharpest rate on the market. A lot of lenders are also offering cashback specials at the moment as well. So a lot of those refinance government fees that you must pay, you can offset them with these cashback specials as well.
Okay. Just now turn to insurance. Over to you, Andrew. My first question is, why do we need personal insurance cover?
Thanks, Kim. Yeah, look, personal insurance cover is designed and tailored for individuals to ensure or protect that that ongoing ability for people to earn an income, and the intent being that you provide financial security for your family right through to retirement, regardless of whether you're able to work or not. The key point that I think a lot of people don't realise is everybody insures their possessions as almost routine, but not many people actually adequately protect their own ability to earn an income. Consider how much we earn over our lifetimes. You know, a typical professional earning 90 to 100,000 at age 30, you're looking at an earnings potential of up to $3 or $4 million if you continue working at that level through to age 65. And then when you think about how much you actually spend on an insurance premium compared to the premiums that you would pay to, you know, insure the typical family vehicle, in terms of return, it doesn't really stack up comparing that motor vehicle insurance compared to how cheap life insurance is, for example. So the main things that we're looking to cover when we're looking at personal insurance cover are the four main types of insurance. You're looking at life insurance, which pretty much does what it says on the box. Total and permanent disability cover, which protects against illnesses or injuries that are so severe that you're never able to go back to work again and never able to earn that income for your family. Next on from that is something called trauma, or also known as critical illness insurance, which provides funds in the case that you're diagnosed with a particular disease, but it's not means tested. And when I say that, I mean, it's not about whether you're able to continue working. It gives you a choice when one of those significant medical events happens as to whether you want to return to work straight away or whether you prefer to take some time to recover, to go through treatment, and then make that choice of when you actually want to return to work. And then the final one, and possibly one of the most important types of personal insurance, is income protection, which it provides a monthly benefit in the case that you're temporarily unable to go back to work, whether that be illness or injury, and that can continue paying for a limited time or right through to retirement. Again, just making sure that that ability to earn an income is protected through to age 65 or age 70. And the key point with personal insurance is it's not a set and forget. The level of cover that you take out should change over time as your situation changes. And I'll speak about the different kinds of things that might trigger that in a minute.
Thank you. So what are the typical triggers for a client to consider taking out or changing their current insurance cover?
Yeah, sure. So I'll refer back to the slide that Jono put up earlier with the different stages of wealth, and actually break down those 5 different categories for you in a sec. But I think the key point here is that unless you're actually a self-funded retiree, generally speaking, we would expect that everybody should have some level of cover, whether that be held inside or outside of superannuation, just to protect the family and their own ability to earn their income, as I mentioned. Looking at an early career stage, I think the key triggers there are starting a new job or finishing university and becoming qualified, and then making sure that the regular increases to income that you'll get as you go through employment or possibly changing employment are actually insured properly. Once you move to the homeowner stage, one of the big triggers there is establishing a new mortgage or refinancing the mortgage when you're purchasing a new home. And at the same time, this is often when people are starting or growing a family. And so adding to the family will often trigger a need to have a look at your insurance or review what you already have in place. When you get to the wealth builder stage, I think the key thing there is that you're making sure that your ability to earn income is fully protected. You'll often be earning at a higher level, less expenses. We want to make sure that the income that you're earning, which is building the wealth, is adequately protected. When you get to the pre-retiree stage, often the interaction that we're having with clients there is making sure that we implement an orderly reduction of cover as you approach retirement, making sure that we keep essential cover in place, but anything that is no longer essential or no longer really appropriate for a client is scaled back, allowing you to focus on building retirement wealth. And then finally, at the retiree stage of life, some retirees will need to keep cover continuing. Often that needs to be tailored to specific risks, particularly particularly if you're looking like you're going to retain a mortgage balance after retirement. If you want to make sure your kids or your grandkids are properly protected, you know, for example, looking after education expenses. And then finally, if you've got a particular bequest or legacy that you want to make sure you leave behind in your estate, you may choose to have an insurance policy that actually funds that.
Thank you. So what are some of the current trends clients should be aware of in the life insurance industry?
Yeah, look, Kim, so at the moment, we're seeing a once in a generation shift in insurance policies. It's been occurring over the last 4 years, and it's certainly looking like it's going to continue for the next 4 years. The shift in the industry has resulted in massive premium volatility. A lot of policy definitions have been changed, and really there's a massive requirement that people need to review their existing policies to make sure they're still adequate and appropriate. A lot of insurers have been reporting huge losses, and this has been linked to unexpected claims experiences, and also to a lesser extent, the underperforming bond markets, where they take their insurance premiums they receive and invest those, have a certain expectation that they'll receive investment performance, which just hasn't materialized. What's ended up happening is APRA has come in and actually put an intervention into income protection, for example. The whole idea around this intervention is to improve sustainability. What they've actually done is cancelled some of the features and benefits that we used to recommend for clients, particularly agreed value policies, which were quite often useful for high bonus, high commission, or self-employed clients. They've also gone and changed how we calculate pre-disability income and the amount of time that we can look back at claim as to how we calculate that income. And they're also scaling back some of the benefits and features that we used to recommend to clients because they're not seen as sustainable anymore. The other thing that we've seen is large premium increases, particularly for TPD and income protection, where it's around your ability to work. And those have been quite significant for insurance held inside super, particularly industry super funds. And we've seen some of those increases slip under the radar because often insurance is not up the front in your superannuation statement. It's on page 5, page 7 when you stop really paying attention. The other thing that the government's done is change eligibility for insurance in super, so that some members are actually being exited from their cover automatically without realising that it's happened. And when they think that they're covered, they're not actually when they go to claim.
Thank you. So what is involved in having a client's insurance cover reviewed?
Yeah, Kim, so again, I'll keep harping on this, but due to these shifts that we've seen in the insurance industry, it's never before been as important as it is now to make sure that your existing cover is reviewed. And the value that our clients are receiving when they do the review process is unprecedented. Our review process is complimentary, and we make sure that the process is easy and efficient as possible. We're, of course, liable for our advice, and we make sure we compare the entire market for quality of policy wordings and competitive of price. And then we come back to a client with a detailed summary commenting on their policy versus the market and the appropriateness of the cover for their particular situation. If needed, after that point, we'll then present advice to the client to implement any improvements that we need to make. And then we manage the finalisation of the application, we complete the policies, and then go into an annual review process to ensure that that cover is appropriate going forward. And we make sure that if a client needs to claim, we are their advocates when it comes time to claim as well.
Thank you, Andrew. So that leads us into estate planning. Robert, can you start by providing us on an overview of what is estate planning?
Well, Kim, in simple terms, estate planning is having the procedures and documents in place to make sure that your wealth is managed by someone you trust in the event of your incapacity, whether that's permanently or temporarily, and of course when you pass away, and that the passing of your wealth is done in with the greatest degree of certainty and in the most advantageous way for the beneficiaries. Now, it's a mistake to think that you've got your estate planning or adequate estate planning if you already have a will. The reason is that a will only covers assets, only deals with assets that you own as an individual. Jonathan and Andrew are both using the term wealth management. And we also use that in estate planning because your wealth covers a much broader range. It's not only assets that you own yourself, but it also includes assets that you own together with somebody else. You may have in superannuation structure, you might have a family trust structure, and there may be company structures. So in estate planning, we look at the overall wealth to ensure that in the event of one of those life crises, and particularly death, that your entire wealth goes where you want it to be. Sometimes I'm asked, well, what does motivate people, or what do people ask for when they, or their concerns when they have estate planning done? There's three basic ones. First of all, that the passing of their wealth is done in the most, with certainty and with a minimum of fuss. People don't like the idea of beneficiaries or families fighting after death. Secondly, that their chosen beneficiaries are the primary people who are benefited. People don't like the idea of beneficiaries' creditors or inheritances being whittled down if a beneficiary goes through a relationship breakdown. So that's often a major concern to clients. And finally, to make sure that the tax consequences of death, either for the estate or for the beneficiaries, is minimised as much as possible. It actually never ceases to amaze me that people spend a lot of time, effort and money in having sophisticated financial planning, sophisticated retirement planning, but they lose sight of the ball when it comes to estate planning. So what we do here at HLB, as Jonathan mentioned, it's a collaborative approach, because the best result for an estate planning client is to involve their lawyer, their accountant, their financial advisors, anyone who has a say or gives advice in the wealth area for the particular client. In normal circumstances, that means the client going off to their lawyer and hoping that their lawyer talks to their accountant, etc. As Jonathan mentioned, here at HLB, we have it all under the one umbrella.
So dying intestate, what are the consequences of this?
Okay, what intestacy is when you die without a will or without an effective will. And you actually, the state of New South Wales gives you a free estate plan. In other words, there's legislation which says who receives your assets. So you have no choice in the matter. Yeah, if you have a will and you've got your estate planning in place, you can say where your wealth goes in the event of your death. If you don't have that in place, the government says where it goes. So it's actually the worst legacy that you can leave your loved ones, because hopefully they're going to grieve your loss, but that grief is only exacerbated if your affairs are not in order, and people have to go through that trauma.
Thank you. And I've heard a lot about testamentary trust lately. Can you explain what a testamentary trust is?
Yeah, a testamentary trust is a trust which is created by a will. So when I'm talking to clients and I talk to them about the options as to how they pass their wealth on to their chosen beneficiaries, the simplest way is just to make it an absolute gift. So for instance, I have two daughters. Okay, when I die, it's divided equally between the two of them. That means, however, that the assets are theirs personally, which minimizes the protection that they would otherwise have, say, in the event of a failed relationship or getting into financial difficulty. Then I explain to clients there is another option. Instead of an absolute gift, you can give them a testamentary trust structure. Now, a testamentary trust must be created in the will. It doesn't come into being until the client passes away. but the structure is there available to benefit the beneficiaries. So again, going back to my example of 2 daughters, I have no concerns about my daughters. I'm happy for them to do with their inheritance whatever they want. So I make the trust optional. There it is, girls. If you want to use it, please use it. If you don't, it's your decision. But it gives them a very tax-effective way of managing their inheritance, and also builds in asset protection. Sometimes clients have what you could probably call vulnerable beneficiaries. So obviously young children can't control an inheritance. So quite often a trust is used to pass the inheritance to the control of the child at a later date. For instance, quite often clients will say, look, I don't want my children to get personal control until they, say, turn 25. Okay, the trust can be structured that way. Other clients might have vulnerable beneficiaries, such as children with an intellectual disability, someone who's never going to be able to control funds, or someone who's a gambler or has a social problem, drugs or alcohol. Often those people need not only protection from other people, but protection from themselves. So in that case, we design the trusts in a different way to be more protective of the beneficiary. But it's the most sophisticated way that you can pass your wealth, and other than the tax-free environment that superannuation provides, in the event of once you're in a pension phase, I think it's fair to say that a testamentary trust is the second most tax-effective structure. So when a client dies, their superannuation wealth must come out of their superannuation environment, and really going into a testamentary trust is offers the beneficiary an ongoing tax-effective vehicle.
So that nicely leads us into superannuation and the superannuation policy and the death benefit therein. What is a death benefit nomination? Okay,
probably at the outset I mentioned wealth, and nowadays a large proportion of people's wealth is their superannuation. Superannuation is not automatically dealt with under your will. The superannuation death benefit is, or who receives it, is actually a decision made by the trustee of the super fund. However, there are procedures whereby you can put in place a nomination where you say, okay, in the event of my death, I want certain people to receive my nomination, receive my death benefit. That nomination can be binding on the super fund, which means they must do that. They must pay it out to whoever I've nominated, or it can be non-binding, where I say, this is who I'd like you to make the who you'd like to pay the death benefit to, but I'll leave it to you as the trustee to make the final decision. So when we talk to clients, it's important for us to understand, okay, hopefully you're going to live to 100 and spend all your super on your, enjoying life. But in the event that you die and there are monies left there, where do you want those to go? And using death benefit nominations is a good way of providing that certainty to clients.
Thank you. So we know how important powers of attorney can be. What's the difference between a power of attorney and enduring power of attorney?
Okay, an enduring power of attorney continues to be effective if you lose capacity. So whereas a general power of attorney ceases to be effective if you lose your capacity. So we strongly recommend that people have an enduring power of attorney, because it's, in the circumstances of your incapacity is probably the main concern that you might have. Once again, however, the power of attorney can be tailored to suit the client's particular circumstances. I'm sometimes asked, when should I consider having a power of attorney? My answer to that is yesterday. in the sense that any adult who owns or controls assets should have a power of attorney in place, and an enduring power of attorney, because none of us know what's going to happen tomorrow. People have sudden illnesses, an accident, whatever. And people mistakenly think that because a couple are married or in a relationship together and they own property together, they mistakenly think, oh, can't we then make a financial decision for each other? No, you can't. If you don't have an enduring power of attorney in place, you need to, and you become incapacitated, then someone needs to make an application to a government department called a guardianship tribunal, which then makes a decision as to who should manage your affairs. So the beauty of a enduring power of attorney is you've made that decision. You've made the decision as to who can look after your affairs, instead of the government stepping in and making those decisions for you. Now, in New South Wales, an enduring power of attorney deals only with financial matters. An attorney cannot make health, medical, and lifestyle decisions for the client. That appointment is done by a separate document called a enduring guardianship. And the enduring guardianship is where you appoint someone who can make health, medical, lifestyle decisions for you in the event of your incapacity. Now, you can have the same person having both roles, financial power of attorney, enduring guardian, or you can separate the functions. And again, it's a matter for us to understand, well, what is the client wanting to achieve? What's the best mix for their personal circumstances? And the documents are drafted accordingly. Just finally, with the, I'm sometimes asked about living wills. Now, living wills are a term particularly used in the US, where people give directions as to how they want to be treated in the event of incapacity. Often, final decisions made about life support in those situations. In Australia, we deal with that through a document called an advanced care direction. And so that's a document where you tell your guardian how they should make decisions in certain circumstances. So it's not uncommon for people to say, look, if the medical advice is that I'm brain dead on a machine, well, let me go. Or if I have a terminal illness, then make sure I'm have palliative care, no pain and distress, but let Mother Nature take its course. Don't revive me if I have a heart attack. People sometimes, I've had people that say that they want to be maintained in their own home. Well, if that's your wish, once again, making sure that that wish is known to those that make the decision.
Thank you, Robert. Thank you so much. So I'm now going to welcome back Jono. We'll now go back to the building wealth stages here. Can you explain to me, because a lot of people simply repay their mortgage and then focus on building superannuation?
Yeah, that's right, Kim. I think, as I said before, most people kind of spend most of their working life just simply repaying that mortgage, and all of a sudden they realise, oh, getting pretty close to retirement age here, sort of thing. I better now start putting some more into super, and that's kind of the typical path for many. I spoke before about at that retirement stage, if you really want to be financially independent, you in fact need to do some what we call wealth building strategies in place as well. So not just spend most of your working life just simply repaying the mortgage. And so when do you start to consider some strategies other than simply paying that mortgage back? And again, everyone's different, but rough rule of thumb that we have is that once the mortgage level is below 50% of the home value, that can be a point where you might want to consider some of these wealth building strategies, and that might be, say, negative gearing into an investment property, gearing into a share portfolio. That one might not necessarily be negative in the current environment. Might simply just be a savings investment approach where you're investing into something with the idea of generating an after-tax return that is greater than your mortgage interest rate cost. Now, at the moment, that benchmark's probably under 3%, as Betty was pointing out. A lot of these loans are pretty cheap at the moment with mortgages.
So how does superannuation fit into all of this?
Yeah, so superannuation is really important, and just as I've spoken before, how this wealth builder stage overlaps with the home ownership stage, that pre-retiree stage superannuation focus also overlaps with the wealth builder changes there. And what's the problem with superannuation is the rules keep changing, and that creates a lot of I guess mistrust with the super industry. Everyone's always worried that the government's not going to change the rules on them, so it won't be as attractive in the future. I think generally over what governments agree is that we need to encourage self-funding of retirement and not have people relying on the age pension. So superannuation, the fact that you're putting money away for a future date, will always be a more tax attractive place to invest than simply in your own name. However, what used to be super planning, we used to do, say, 5 years before retirement. Now it's something we need to start considering 20 years pre-retirement there. And these contribution limits have come down dramatically over the years. 13 years ago, there were no limits on how much you could put into superannuation. Then all of a sudden they announced this $1 million sum that you could put into super in 1 year, and many people went hell for leather putting the $1 million into super. And over the last few years, that amount's dramatically being reduced with this what's called a non-concessional, or your large contribution that you can put into super, now down to about $100,000. Well, it's $100,000 per annum, as long as your current super balance is lower than $1.6 million. So they're really now limiting people being able to build up really significant amounts within the superannuation environment. Probably the bigger part with super, and I spend a lot of time having a chat with all the accountants or the tax guys in here, is this concessional contribution, this $25,000 amount that can be a deductible contribution. And the tax rates have changed again, and so this second highest tax rate, the 37% rate's now been increased to $120,000. So certainly for people at that earning above $120,000, there's some really significant advantages for them if they are only currently putting their SG contributions into their super. So the employer's putting in the compulsory, it's 9.5% for them. They could put, say, $10,000, take it out of the offset account, put $10,000 into their super at year end. That's providing them with a personal tax deduction at 39%, $3,900, and yes, the super fund pays 15% tax, but it's still resulting in a net tax saving of $2,400. So that's a pretty good return for that $10,000 investment to to be getting back $2,400 in the pocket there. So really making sure not wasting these years where you're able to put these maximum $25,000 sums into your superannuation. Most people should be doing it. Well, there's a great rule in at the moment. This is called this carry forward for people with balances, super balances less than $500,000. Any unused of their concessional contribution caps can be carried forward for up to a 5-year period. So that's fantastic for people with lower super balances in order to be able to catch up. And for whatever reason, if they have a high tax income year, really knock that right down with a large superannuation deduction there.
So, Jonna, can you explain how the 1.6 million pension cap works? Is this the total sum you can now build your super account to?
Yeah, I think that's a good point, Kim, because there's been a lot of confusion since this came in, 2017 year where this $1.6 million transfer balance cap, and the point with that is not so much that that's not So, for instance, if you're a person aged 65 years of age and your superannuation is now built up to a $2 million sum, what that simply means is that only $1.6 million can go into the pension account, which is the tax-free account that you can have invested. That remaining $400,000 can stay within superannuation, and that would then just continue to be taxed in the 15% tax structure, which is still lower than most of the individual tax rates. It's still the right place to be for retirement wealth. You still want to be building up most of that within the superannuation environment. The tricky part is that once your actual superannuation balance reaches $1.6 million, you can no longer put in those large $100,000 non-concessional amounts into your super balance there. So the earlier you can build up your super balances and then let earnings kind of grow it, hopefully above the $1.6 million balance, then the better you'll be. Importantly, now you must be planning for couples. They should be looking to grow their superannuation balances together. There's no point, perhaps the higher income earner building up a really significant superannuation balance, and the other one, the other spouse having a very low and not maximising that $1.6 million cap. So for couples, they've got $3.2 million that they can have invested in a pension accounts tax-free. That's the current government maximum amount for pension accounts. So they should both be trying to utilise those sums.
Thank you. Well, look, we've got a few minutes remaining. So what I think we might do is I'd like to thank our panellists this morning. It was a very comprehensive presentation, and a recording of this session and the PowerPoint slides will be sent to you shortly. But I'd like to just hand it over to Jono just to wrap up any final comments that you may have.
Sure. Well, thank you everyone for joining the seminar. I hope there's been something of interest that you've found in today's chat. I think I'm fairly excited with our offering that we've got for clients. As you've heard, we've now got a number of specialists in the firm, and to be able to have your debt, your insurance, your estate planning, your personal investments, and your superannuation, together with all your accounting compliance needs, your individual tax returns, and if there's other structures all involved, to be able to have that all in the one place, to me just makes it easier, much easier for people to run their personal financial needs there. They don't have to tell their story 5 different times to 5 different people and hope that sometimes they may talk to each other if there's anything that they need to sort of discuss there. We all sit together. We're all in fact on one level in the place here, and we all get on well. So I think we've got a really great solution for clients, and it is actually fairly unique. It's strange. You'd think that more accounting firms would be in this space, but what we offer is a fairly unique solution, and I think it's a very good one for clients.
Thank you, Jonathan. So I'd like to thank you again for joining us this morning and thanking our panels. On behalf of myself and the team at HLB Mann Judd, I'd like to wish you a Merry Christmas, a festive season, stay safe and well, and bring on 2021. Thank you so much.